Alright, Chapter 3 is accrual accounting. So the learning objectives, we're going to look at accrual accounting concepts, we're going to look at some transactions, end of period adjustments, balance sheet, the other financial statements, and why we use accrual accounting. So let's dive right into learning objective 1. So why is accrual accounting needed? Well, in business, three things happen. We earn revenue, we incur expense, and then we pay the cash or receive the cash for revenue or expenses. So accruing revenue, let's take a look at the timing of when we would recognize revenue. So let's look at Joe's lawn service. Joe does lawn work in June, he invoices the customer in June, but he gets paid by the customer in July. What month would he recognize revenue? Well, it would be in June because that's when the services are provided and the customer is invoiced. So let's go to the other side. Let's look at expenses. So Joe uses some fuel from Mobil in June to do that lawn work. He gets the invoice from Mobil in June for the gas that he used, but he pays Mobil in July. What month would the expense be recognized? It would be recognized in June when the materials are purchased and when he gets the invoice to pay for it. So that brings us to the matching principle. The matching principle tells us that the expenses incurred to generate the revenue are recognized in the same period as the revenue. So if we look at Joe's lawn service, the work he did in June to mow lawns, we have both the revenue and the expense for the fuel that he used both in the same period. So let's take a look at some So we're going to look at Family Healthcare. They're a healthcare organization. We provide services to patients. Third bullet's pretty important. Revenue is earned when the service is provided to the patient, not when the patient pays. Then if we look at the last bullet, expenses are recorded as they are incurred, not when they're paid. And that goes back to our accrual method of accounting. So let's take a look at our first transaction. So we received some rent in advance for $1,800 from ILS Company for letting them rent our land. So looking at this transaction, cash is coming in for $1,800. So we increase cash on the balance sheet and then increase operating cash flows on our statement of cash flows. Then the other side of our entry is a liability called unearned revenue. And the amount will stay in the unearned revenue account as a liability until the revenue is actually earned. What that means is that as time goes by and ILS Company uses up that $800 of rent that they've paid, then we can start recognizing revenue. Until then, it goes under unearned revenue. So let's look at some prepaid expenses. So we bought a 2-year insurance policy in advance for $2,400. Cash goes out the door for $2,400, reduce cash on the balance sheet. Then our statement of cash flows show our operating cash outflow. On the other side of our entry, we increase an asset account called prepaid insurance. So with prepaid insurance, the amount paid is showed as prepaid expense as an asset until the insurance is actually used up. And once the insurance is actually used up, we'll recognize insurance expense. Let's take a look at a 6-month medical malpractice policy that we paid in advance for $6,000. It's the same thing as the last one. Cash goes down $6,000, and then we increase our prepaid insurance by $6,000. And let's take a look at the next transaction. Dr. Landry investing an additional $5,000 in the business for some capital stock. So we increase cash because cash is coming into the business, and that's a financing item on our statement of cash flows. And then we increase capital stock because we're issuing some stock to Dr. Landry. And now we're going to buy some supplies for $240 on account. What on account means is that we're buying the supplies this month, but we're not going to pay the bill until next month. So we're buying them on account. We have a promise to pay in the future. So we increase our asset supplies, and then we increase a liability called accounts payable, which is a promise to pay somebody in the future. Now we're going to purchase some office equipment. We made a $1,700 cash down payment, and then we're going to make 5 installments of $1,360. So we decrease cash by $1,700, which is the down payment for cash, and then that goes out of our investing activities on our statement of cash flows. Our remaining balance due is $6,800, which is the $1,360 times 5 installments. And notes payable is a written obligation for us to pay somebody in the future. And then our total value of office equipment and assets is $8,500, which is the $6,800 note payable plus the $1,700 cash payment. Remember, we record assets per GAAP at cost, and cost for this office equipment is $8,500. So here we provided services to customers for $6,100 on account, which means we did the work to the customers, but they haven't paid us yet. So we're going to increase an asset account called accounts receivable, which is a promise for somebody to pay us in the future. And then we're going to increase retained earnings by $6,100 because we know that revenue increases retained earnings. And then our income statement, we're going to show revenue of $6,100. So now we're going to do services to patients, but they're going to pay $5,500 in cash. So you can see our cash increase is $5,500. It's a cash inflow. And then we increase retained earnings for $5,500 because revenue increases retained earnings. And then we show revenue on our income statement for $5,500. Now we received $4,200 in cash payments for prior services performed. So remember that work we've done on account. So now we're going to decrease our accounts receivable by $4,200 because that we originally had $6,100 worth of obligations for people to pay us. Well, $4,200 was paid, so we reduce accounts receivable and we increase cash because $4,200 of cash is coming in the door. And then our other, remember we bought supplies on account. Well, now we're paying $100 of that account. So $100 of cash is going out the door. And then we reduce our accounts payable by $100 because we're fulfilling $100 of the $240 obligation we had before. And now we incurred some expenses for the month of November, and we paid cash for them for $4,690. So for cash, we show a negative $4,690 to our balance sheet. Cash is going out the door. We show $4,690 going out the door as an outflow in our statement of cash flows in the operating section. And then on our income statement, we have $4,690 worth of expenses. And then we know that expenses reduce retained earnings. So we show the negative $4,690 to retained earnings. And now finally we paid dividends of $1,200. So with dividends, cash is going out the door for $1,200. And then we know dividends reduce our retained earnings by $1,200.